Hello, in this lecture we're going to talk about the comparison of the flexible budget to what actually happens. At the end of this, we will be able to create a flexible budget, compare a flexible budget to actual performance, and explain why a flexible budget is a valuable tool. So we're going to start off with the comparison of a standard fixed budget to what actually happens. So this is going to be the standard budgeting process. We set up a budget, the budget is fixed, the budget is based on 18,000 units of production, and then the time period had passed, and we see what actually happened in terms of the sales, and we have 21,000 units that were actually sold and produced. So we have our normal income statement in terms of a budgeted income statement, as well as the normal income statement, the actual income statement, and of course we'll just compare those two things out. And we can see that the layout of the income statement is going to be by category. So we've got the sales, we've got the cost of goods sold. What's in the cost of goods sold? We put in there the things that are related to the inventory that we use in order to help generate revenue by selling it. And then we've got the selling expenses, and we have the general and administrative expenses. So we're going to do the comparison between these two. If we just go line item by line item, we would say the sales, we have the 4,050,000 minus the 4,803 gives us this 753,000. That's good. And of course, why is it good? Well, of course, it's going to be higher because we actually sold more on the actual here. We sold 21,000 compared to the 18, so we would expect the sales revenue to be higher. If we looked at the direct materials, this is what we budgeted. This is what actually happened. We're going to say that in this case, this is unfavorable, we would say, because it's higher. What actually happened is higher. The direct labor is going to be, this is what we budgeted. This is what actually happened. It's going to be unfavorable because it's higher. The machinery repairs, it's variable cost. We've got the 90 and the 97. It's unfavorable. And the direct, the depreciation, it's the same. This is what happened. This is what we budgeted. This is what actually happened. It's the same, so no difference there. Utilities, this is what we budgeted. This is what actually happened. It looks unfavorable. What actually happened is higher in terms of the expenses. Plant management salaries, this is what we budgeted. This is what actually happened. What actually happened is higher. That's bad for expenses. Total cost of goods sold is higher in terms of expenses in the actual than what we budgeted for. And gross profit is going to be higher as well, and that's actually good because that's going to be the sales less the cost of goods sold. And then if we take a look at the selling expenses, the packaging, this is what we budgeted, this is what happened. That's not good, that's unfavorable. The shipping, this is what we budgeted, this is what actually happened, unfavorable. The salaries, unfavorable. So we see kind of a big trend happening here. We got the advertising's unfavorable, no change here, and unfavorable. So why is this happening, of course? Well, part of the reason is that we produced more than we thought we were going to produce. So we can't really do as much as we would like to with these types of numbers. We can't go to the production department and say, hey, you're over budget in terms of the materials, you're over budget in terms of the labor. We can't really do that because what actually happened, of course, is we produced more than expected. So of course we're over budget. That's going to be the problem. So what can we do to fix that? How can we fix this problem? Well, we can make a new budget. We can make our budget flexible. We can say, okay, this is our budget if we were at 18,000 units. What would happen if we made our budget based on a 21,000 unit flexible budget and then did this comparison? Then we can actually hold people accountable. We can actually then take those numbers and say, let's make decisions on these. Let's see who did well, who did poorly, and see how we're doing. So in order to do that, I won't go through the entire creation of the flexible budget, but we did that last time. But in this case, we're going to have the variable portion, we're going to have the fixed portion, we're going to rearrange our budget here, which was based on a fixed 18,000 units, and rearrange it based on the type of cost, meaning variable versus fixed. So we'd start off getting the per unit amount. So if we're going to take this 4,050,000 divided by the 18, that's how we're going to get this 225 here. So we're taking the 4,050,000 divided by 18,000 units. That gives us this 225. We did that all the way down for the variable cost, and then we pulled the fixed costs down here. We would just keep this process. We'd have the direct materials, 1,080,000 divided by the 18. That gives us the 60. Direct labor, 270,000 divided by the 18. That's going to give us the 15. If we get to the machinery, that's going to be variable, 90,000 divided by the 18,000. That gives us the 5. When we get to the depreciation, we're going to pull that down into the fixed portion. It's not going to change with the level of production, so we put this in the outer column. We're keeping the amount total because that's just going to be the same for all of our budgets. It's not going to flex. It's not going to be different. And then in terms of the utility, we broke that out into a mixed cost. So that's 72,000 of it is variable. So we take that 72,000 divided by the 18 and we get our variable portion on the utilities. The plant manager, that's fixed. It's a salary. It's going to be down here in the fixed area. Then we have the total cost of goods sold. That's a subtotal. It's not going to be over here because it's a subtotal. Gross profit, subtotal. That's not going to be over here because it's a subtotal. And then we've got the selling expenses, packaging. We said that the packaging is variable, so we take the 108 divided by 18. That's going to be this $6 per unit here. The shipping we said was variable. That's a 144 divided by the 18. That's going to be the 8 over here. And then the salaries, that's going to be fixed. It's a salary, so that's going to be in the fixed areas over here. And then we've got the advertising, the salaries, again, and the entertainment, all fixed costs, so those are going to be down here. So we've got all of our costs accounted for. We put the variable cost per unit. We kept the fixed cost fixed. And next step is that we can convert our standard budget now to a flexible budget based on what actually happened. What actually happened? 21,000 units. So now we can take all of our variable costs and say, okay, well, what would have happened? What would we think should have happened if we were to produce 21,000 units? So we can take the sales times 21,000. So that's going to be the 225 times 21,000, 4,725,000, and do this for the variable cost. So direct materials, 60,000 times the 21,000, 1,060,000. We can take the 15,000 direct labor times the 21,000, 315, and then we're going to take the 5 times the 21,000, 105. We're going to take the 4 times the 21,000, which is the 84. Then the 6 times the 21,000, the 126, and so on. The 8 times the 21,000, 168,000. Then we can take the total variable cost per unit times the 21,000, or we can just sum up the variable costs here to get the total of 2,058,000. Same thing for the contribution margin. The contribution margin being the sales less the variable cost. The 127, we could take that times the 21,000, or we can take the sales less the variable cost to get the contribution margin total, 2,667,000. And then the fixed costs are nice and easy. That's why we broke them out down here. We just pull those over. They're all the same. Fixed costs will be the same. Now we have a budget that we can compare. Notice that the fixed costs weren't a problem. The variable costs are where we have an issue. So now we can take these numbers. We can say, okay, now we put these numbers in place, and now we just need to compare that to what actually happened. Now, in order to do that, we got to take what actually happened in this column, and we need to then redistribute it into this format that we have just come up with so that we can do the comparison, so we can see what the difference is. So we're going to take the sales, obviously. Sales, we're just going to pull over there, and we have a difference here, and that's going to be a favorable difference. So we still have a favorable difference on the sales, even at our budget being flexed to the 21,000. And then we've got the direct materials. So direct materials, if we compare that out, here's what we would expect to happen at the production level of 21,000, which was the actual production level. And this is what actually happened. So we have a difference of 15. It's unfavorable. Notice this gives us more information. We couldn't go to the production department before and say, hey, you were over budget here in direct materials by 195,000. Really, if we flex the budget to what would be expected at that production level, they're only over budget by 15,000. Now that's not the whole story still, because there's two components that we'll talk about next time. Meaning there's a price component. Is it that we spent more than we thought, or did we use too much material? So those are going to be some issues. We're still going to have to break that out in order to really know. In order to really hold someone accountable, we're going to have to break those numbers out so we have numbers that we can directly apply to departments. So we have the direct labor here, direct labor. We're going to pull that number over. Same thing. It's still unfavorable, but it's a lot more accurate than the 52,000 here. We're unfavorable by 7. So again, we can go to the department and say, hey, you're still unfavorable. We did a flexible budget, and based on the 21,000, we still have this unfavorable difference here. We still have a problem. We need to do better. But again, we need to break that out a bit more, because it could be the fact that we paid more than we thought in terms of salaries, or it could be the fact that we used more hours than we budgeted to use. We need to break that out and say, what's really going on here? What's the difference? But this is much better than having the standard budget. So then we're going to have the 97,000 in terms of the machinery. compare that out, and we get an 8,000, and that's a favorable difference. We've got the 83,000 in terms of the utilities. Notice we're skipping down to the utilities. We're taking the variable portion and we're giving the 83,000 as the variable portion on the actual here as part of the problem. That's a favorable difference. The packaging here, where's that? Packaging 123, that's a variable cost compared to what happened. We got a favorable difference here. And then we've got the shipping here compared to what actually happened, and that's the favorable difference. And then we're going to pull over the other costs. These are the fixed costs. So we can total this up, the total variable. We can subtract these out here, or we can just add these up here to get the variable portion. And then contribution margin, same thing. We could subtract this out, or we could take the sales difference less the variable cost difference. And then we can pull over the fixed costs. So if we just go through the fixed costs down here, we've got the depreciation, and it stayed the same. That one should almost always stay the same because we calculated it's an estimate. The utilities is going to stay the same, or we have a difference in the utilities of the 3,000, so that's a favorable difference. And then we have the plant management salaries, the 240, and we have a difference of the 10,000. That's going to be unfavorable. We've got the sales fixed, the 279, and that's going to be a 19,000 unfavorable. We've got the advertising expense. We spent 7,000 more than expected on the fixed budget. Salaries and administrative, that one actually is the same. And we've got the entertainment, and that one is going to be unfavorable. All right, so this is going to be the information we have here. We'll bring down the totals and the total differences. And note that this type of information over here, especially for the variable side of things, is going to give us a lot more information than a fixed budget. So any company is going to have a fixed budget. They're going to come up with what they think will happen in terms of production level. And some companies the more we have this variable portion and the more we want to hold people accountable, the more likely it will be worth it to make a flexible budget in order to drill down on those numbers. When we think about a manufacturing company, that's often very, very useful because, like we say, if we just have this budget over here, we cannot really hold people accountable as easily because we don't have the metrics to say whether they did well or not, because this budget just doesn't tell us how we did in terms of direct materials, direct labor. And even this budget, we're going to have to break it down even further into its components, the price components and the quantity components, to really drill down and see that. Now, if we're talking about some other types of businesses which have far less variable costs and much of their costs are fixed costs, possibly some types of service businesses, it may be less useful to them to break something out like this. So there's always going to be a cost-benefit analysis we want to put together in terms of, do we want this more information? Remember that this is managerial accounting. This isn't required information. This is for internal use. And the question is, does this added information add to our overall performance? And that's a question for a cost-benefit analysis.